Welcome to Chapter 18, where we dive into process costing. This chapter focuses on understanding manufacturing costs, specifically how costs move through continuous production systems. Unlike job costing, process costing is used when products are made in a series of ongoing processes, making it essential to track costs accurately through each stage. We'll explore how costs accumulate and flow to give a clear picture of manufacturing expenses in these settings. Here, we're comparing process costing and job costing, two methods used to track production costs. Process costing is ideal when you have a continuous flow of identical units. Think of products that are homogeneous and look the same, like chemicals or packaged foods. In this system, costs are collected by department and then averaged out per unit, since it's hard to distinguish one product from another. On the other hand, job costing is used when production involves distinct jobs, batches, or custom orders. These products differ in materials, labor, or design, so costs are directly traced to each specific job. The key takeaway is that process costing suits a large volume of uniform output, where costs are averaged across all units, while job costing is better when each product or batch is unique and needs individual cost tracking. Now, let's look at the various industries that commonly use process costing. This costing method is particularly suited for sectors where production is continuous and the products are indistinguishable from one another. Industries like chemicals, petroleum refining, food and beverage, and pharmaceuticals rely heavily on process costing to track their expenses accurately. Additionally, paper and pulp production, as well as cement and glass manufacturing, also utilize this approach. Understanding how process costing applies across these industries helps us appreciate its importance in managing costs and ensuring efficient production processes. This overview sets the stage for a deeper dive into process costing itself in the following sections. In Chapter 1, we focus on the key assumptions underlying process costing. First, we assume that the units produced in a department are largely homogeneous, meaning they are very similar or identical. This simplifies cost tracking since each unit is treated the same. Next, we consider continuous flow, which means production moves steadily through linked stages without interruption. This seamless movement is essential for efficient processing. Moving on, average costing is applied, where department costs are spread evenly across all units worked on during the period. This approach allows for a uniform cost per unit. Lastly, we emphasize the period focus, where costs are accumulated by process for a specific time frame, helping us understand and control costs within that period. These assumptions form the foundation of process costing and guide how we account for production costs. Process costing is best suited for situations where we have continuous flow production. This means identical units are moving through the same set of production steps over and over. Instead of tracking costs for each individual unit, we accumulate costs by the process. This approach helps simplify cost accounting in environments where products are indistinguishable from one another and produced in large volumes. Understanding this is key because it allows companies to efficiently assign costs when dealing with mass production. Now, let's talk about how we calculate the average unit cost in process costing. The key idea here is that we take the total production cost for a period and spread it evenly across all the units produced during that time. This means we are dividing the total cost by the total units to find the average cost per unit. It's a straightforward method because it assumes every unit costs the same to produce, which makes sense when products go through a continuous, uniform process. So, by using this approach, we get a clear picture of the average unit cost, which is essential for pricing, budgeting, and cost control. Here, we're looking at the basic cost flow in process costing. It starts with raw materials, which represent the direct materials cost. These raw materials are then moved into work in process, where direct materials are combined with labor and overhead costs. As production advances, these costs move along with the units through the process. Once the product is completed, it becomes finished goods, and the total accumulated cost is referred to as the cost of goods manufactured. This flow illustrates how process costing tracks and assigns costs at each stage, ensuring accurate cost measurement as products progress through production. Understanding this flow is crucial for managing and controlling production costs effectively. Here we have the 5 key steps of process costing laid out clearly. First, we start by summarizing the flow of physical units of output, which helps us understand how many units we're dealing with throughout the process. Next, we compute output in terms of equivalent units, converting partially completed units into a common measurement to simplify cost calculation. Then, we summarize the total costs that need to be accounted for, including materials, labor, and overhead. After that, we compute the cost per equivalent unit, which gives us a clear cost value for each unit produced. Finally, we assign the total costs to the units completed and to those still in ending work in process, ensuring accurate cost distribution. These steps form the backbone of process costing and make it easier to track and manage production costs. Here we are looking at the first step in process costing, which is summarizing physical units. The key idea is to track all the units involved during the period, making sure we account for every single one. We start with 8,000 units that were already in process at the beginning. During the period, 42,000 more units were started. This gives us a total of 50,000 units to account for. Now, on the other side, we see how these units are distributed. Out of the 50,000, 44,000 units have been completed and transferred out, while 6,000 units remain in the ending work in process. This step is crucial because it helps us clearly understand where all the units came from and where they ended up, setting a solid foundation for the rest of the process costing steps. Now, let's focus on the concept of equivalent units, which is essential for process costing. Equivalent units help us translate partially completed output into the number of whole units that could have been finished during the period. For example, imagine we have completed 8,000 units and an ending work in process inventory of 2,000 units that are 40% complete. To calculate equivalent units, we count the 8,000 completed units as full units. For the ending work in process, we multiply 2,000 units by 40%, which gives us 800 equivalent units. Adding these together, the total equivalent units amount to 8,800. This calculation allows us to accurately assign costs to completed and partially completed units, ensuring proper costing in the process. Now, let's focus on the concept of equivalent units and how partial work is converted into full units. Equivalent units allow us to express unfinished products in terms of fully completed units. For example, if we have a unit that is 50% complete, we count it as half of a finished unit for the relevant cost category. So, if there are 100 units that are 50% complete, that equals 50 equivalent units. This method is critical because it enables managers to measure production output accurately, even when some goods are still in process at the end of the accounting period. Understanding this step is essential in process costing, as it helps allocate costs precisely based on the degree of completion. Here, we're focusing on summarizing the costs to account for in process costing. Essentially, we combine the costs that were already in progress at the beginning of the period with the costs added during the current period. This gives us the total costs to account for. We start by taking the beginning work in process balance, then add the current period costs, which together form the full amount of costs that need to be allocated. This step is crucial because it provides the foundation for accurately assigning costs to units completed and those still in process. Understanding this summary helps ensure that all costs are traced properly and that the cost flow is clear and complete. Now let's focus on step 4 of the process costing method, which involves calculating the cost per equivalent unit. This step is crucial because it allows us to assign costs accurately to the units produced during a specific period. First, we need to consider materials separately. Since materials might be added at different stages of production, we calculate materials cost per equivalent unit by dividing the total material cost by the material equivalent units. This ensures we reflect the actual input of materials. Next, labor costs are handled similarly. We divide the total labor cost by the labor equivalent units. It's important to note that this calculation is based on the work performed during the period, not just on the units that were completed. This helps capture the effort put into partially finished goods. Finally, overhead costs are calculated the same way, dividing total overhead costs by overhead equivalent units. Overhead typically follows the conversion activities and is often grouped together with labor costs in practice. By using this core formula, total cost divided by equivalent units, we get the cost per unit. This value is essential because it gives us a clear picture of how much each equivalent unit costs to produce, which aids in accurate inventory valuation and cost control. Now, we're at step 5, which is assigning costs to outputs. Units that are completed and transferred out during the period receive the full cost assigned to completed production. For example, if 8,000 units are completed and the cost per unit is $4.50, the total cost assigned to these units would be $36,000. For ending work in process, which consists of partially completed units, costs are assigned based on their equivalent units for materials and conversion costs. For instance, if we have 1,000 equivalent units for materials at $2 each, that totals $2,000. For conversion, if there are 600 equivalent units at $2.50 each, that's $1,500. Adding these together gives us a total of $3,500 allocated to ending work in process. So, essentially, we take the cost per equivalent unit and divide the total production cost between the finished units and the units still in process at the end of the period. Let's walk through the 5-step process of the chapter workflow for process costing. First, we start with physical units. This means tracking how many units have been started, how many are completed, and how many are still in process. Next, we move to equivalent units, where we convert partially completed units into whole units to get an accurate measure. Third, we look at costs to account for. Here, we combine the costs from beginning inventory with the costs incurred during the current period. Then, in step 4, we calculate the cost per equivalent unit by determining the average cost assigned to each equivalent unit. Finally, we assign costs by allocating them between completed units and the ending work in process. This 5-step process helps ensure accurate and organized cost tracking in process costing. The weighted average method in process costing combines the costs in units from the beginning work in process inventory with those from the current period. This means that instead of separating prior period work, all units are included together when calculating equivalent units. The costs from beginning inventory are carried over and merged with the current period's costs, creating one total cost pool. By blending past and current work in this way, we end up with a single average cost per equivalent unit that applies to all output. Essentially, this method smooths out costs by averaging everything, making it easier to assign a consistent unit cost throughout the production process. The core idea behind the FIFO method in process costing is to treat the beginning work in process inventory separately from the current period's production. This means that when we calculate costs for units completed this period, we only assign costs related to work and materials added during the current period. First, we finish the work that was left incomplete from the last period. Once that work is completed, we add the units that were both started and finished during this period. When calculating equivalent units, we count only the remaining effort needed to complete the beginning inventory, plus all the work performed during the current period. It's important to keep prior period costs separate and use only the current period's costs to compute the unit cost for the units completed this period. This method ensures a clear distinction between work and costs from previous periods and those incurred during the present period, which provides a more accurate cost allocation in process costing systems using FIFO. Let's dive into the differences between the weighted average and FIFO methods in process costing. Starting with weighted average, this approach blends costs from different periods, including the opening work in progress. Because it mixes these costs together, it tends to produce a smoother unit cost over time, which can make cost fluctuations less pronounced. One of the advantages here is simplicity. It's generally easier to apply since you don't have to track costs separately for each period. On the other hand, FIFO keeps periods separate. It focuses only on the work done during the current period, excluding any costs from previous periods. This means it offers a more precise view of current period costs, making it better for identifying recent cost trends. So, if you want to analyze how your costs are changing over time, FIFO can provide clearer insight. Both methods are used in process costing, but choosing between them depends on whether you prioritize simplicity and smoothing or period-specific accuracy and trend analysis. When beginning inventory is small, using the weighted average method becomes quite effective. If there's limited work in process at the start, blending prior and current costs doesn't significantly change the unit cost, so this approach works well. Also, when cost fluctuations are modest and prices or production costs remain relatively stable, averaging costs provides a practical and reliable measure. Weighted average is also beneficial when fast reporting is important because it simplifies calculations by not tracking beginning inventory separately. This method suits continuous and uniform production processes, especially in steady, repetitive operations where combining units and costs aligns closely with how the production actually runs. Overall, weighted average is best chosen when simplicity matters more than distinguishing the costs of beginning inventory from current work, making it a straightforward and efficient option in many process costing scenarios. When managers want a clearer understanding of current period production costs, FIFO is often the preferred method. This is especially true when costs fluctuate noticeably, as FIFO helps separate costs from prior periods and highlights trends from the current period. If the beginning work in process inventory is significant, using FIFO is beneficial because a large opening inventory can skew averages under the weighted average method. Performance measurement is another important consideration. FIFO provides the cost of the work actually completed during the current period, which leads to more precise unit costs. This precision becomes critical when accurate inventory valuation is necessary. In process costing, selecting the right method is key, and FIFO stands out when you need sharper insights into cost behavior and more detailed performance tracking. In this chapter, we're focusing on the challenge of transferred-in costs. One of the key points to understand is that costs don't start from zero when units move between departments. Instead, each unit carries with it all the production costs from the previous stages. This means that every department has to track not only the costs it adds but also the costs that have accumulated up to that point. If these transferred-in costs are not recorded accurately, it can distort the unit costs calculated in every department that follows. This is a critical aspect of process costing, as it ensures cost accuracy throughout the entire production process. Transferred-in costs are expenses that originate in one department and are passed along to the next as the product moves through the production process. Think of it as costs that are carried forward from one stage to the next. For example, Department A starts by adding certain costs to the product. When the product moves to Department B, it not only receives the costs added by Department A but also adds its own additional costs. This process continues to Department C, which accumulates all prior costs from Departments A and B and adds even more. Essentially, costs build up progressively as the product travels through each department. This concept is a key part of process costing, helping companies accurately track and allocate costs at each step of production. Understanding how transferred-in costs work is crucial for managing overall production expenses effectively. When accounting for transferred-in costs, it's important to treat these costs as a separate category within the receiving department. Think of them like materials that are added at the start of the process in that department. To track these costs, we use a T-account setup for work in process in Department B, where debits represent costs added and credits show costs transferred out. Regarding the methods for including transferred-in costs, there are two main approaches, weighted average and FIFO. The weighted average method blends the beginning inventory costs with the current period transferred-in costs to create a single average rate. On the other hand, the FIFO method keeps beginning inventory costs separate and assigns only the transferred-in costs from the current period to the work done during that period. Understanding these distinctions helps us accurately allocate and account for transferred-in costs within process costing, ensuring clearer cost tracking and better decision-making. Now, let's talk about how transferred-in costs are handled in process costing, focusing on Step 2, equivalent units, and Step 4, cost per unit. For Step 2, when we calculate equivalent units for transferred-in costs, we treat these costs as their own separate category. This is because the beginning work in process and the new units are already fully transferred in before the department starts any additional work. Typically, the units still in ending work in process are considered 100% complete with respect to transferred-in costs, which simplifies our calculations. Moving to Step 4, we calculate the cost per equivalent unit for transferred-in costs by dividing the total transferred-in costs by the transferred-in equivalent units. This calculation is done separately from the costs related to materials and conversion. Once we have the cost per unit, we assign it to both the units completed and the ending work in process. We then add this amount to the current department's costs. The key idea here is to think of transferred-in costs as if they were materials added right at the start of the department's process. This approach makes it easier to track and allocate costs accurately. Overall, treating transferred-in costs as a separate cost category ensures clarity and precision in our process costing system. Here, we're looking at how transferred-in costs work in a multi-department process. As units move from one department to the next, their associated costs move along with them. Starting in Department 1, which is the mixing stage, both materials and conversion costs are added to the units. Once these units are completed here, their costs become what we call the transferred-in cost for the next department. In Department 2, the assembly stage, the costs from Department 1 are now part of the current costs. Additional costs are added as more work is done, resulting in more completed units with accumulated costs. Then, these units and their combined costs move on to Department 3, packaging. Finally, in Department 3, the final cost is assigned to the finished goods. Throughout this entire process, each department contributes new costs, but all the prior costs from earlier departments are carried forward with the units. This continuous transfer and accumulation of costs is a key feature of process costing. Hybrid costing systems are an interesting mix because they combine two different approaches, job costing and process costing. This method is particularly useful when a company needs to track certain production costs continuously, like in a process, but still needs to assign other costs specifically to individual jobs, batches, or particular product features. Essentially, it's a way to capture the best of both worlds, allowing for detailed cost tracking without losing the broader view of ongoing production. This balance helps businesses get more accurate cost information, especially when their operations don't fit neatly into just one costing system. Operation costing is a hybrid approach that blends elements of job costing and process costing to suit specific manufacturing scenarios. Essentially, it uses job costing for materials, meaning that material costs are tracked by batch or customer order, allowing for differentiation based on unique options or customizations. Meanwhile, labor and overhead costs are treated like process costing and averaged across the entire operation. This approach is especially effective for products that are largely standardized but offer some customizable features. By combining the strengths of both costing methods, operation costing provides a flexible and accurate way to assign costs in complex production environments. On this slide, we're comparing three main costing methods: job costing, process costing, and operation costing. First, job costing is used when costs need to be tracked for individual jobs or projects, typically customized products like custom furniture. The costs flow directly from the job to finished goods, making it suitable for low volume and high variety production. Process costing, on the other hand, applies to continuous or mass production of homogeneous products, such as paint production. Here, costs are accumulated by department or process, flowing continuously from one process to the next. It's best for high-volume, continuous operations where products are similar. Operation costing is a hybrid approach, combining batch processing with process costing. It's useful when products share similar processes but have customization options, like bicycle assembly. Costs are tracked by operation and batch, reflecting both standard bases and custom finishes. Understanding the basis, tracking methods, cost flow, and best use cases for each helps in selecting the right costing method depending on the production type and product nature. This comparison clarifies how these costing systems differ yet complement different manufacturing environments. When we talk about hybrid costing, it's important to understand its unique position between job costing and process costing. Hybrid costing is ideal when products share a common base, they go through the same core materials and processing, but then diverge based on model, size, or specific features. Essentially, the customization happens late in the production process. In these cases, apply hybrid costing when the initial stages of production are identical for all units, but customization only takes place in the final operations. For departments running continuous work, you can use process-style averaging to allocate shared costs efficiently, while special conversion or finishing costs are traced by batch or job to capture those differences accurately. If neither pure job costing nor pure process costing fully fits your situation, hybrid costing offers a middle ground. It's especially useful when job costing would become too detailed and cumbersome, and process costing is too broad to reflect actual cost differences among products. So, when your production blends standardized processing with product-level customization, operation costing within a hybrid system provides a clear, practical method for costing. Process costing is a method used to determine the cost of producing large batches of similar products. For example, a bicycle manufacturer creates standardized frames, wheels, and other components through repeated assembly stages. In this system, costs are accumulated by department, such as frame fabrication, painting, and final assembly, rather than by individual units. Then, an average unit cost is assigned to each identical bike as they move through the production process. This approach works best for high-volume products where materials, labor, and overhead remain consistent. To put it simply, process costing helps companies efficiently track costs when producing many units of the same type, like in bicycle manufacturing. When we talk about drug manufacturing, process costing is a perfect fit because the production involves repeatable and tightly controlled stages. Large batches of drugs move continuously through specific steps like mixing, filling, and packaging. To accurately track production, we use equivalent units, which help measure partially completed products on sterile production lines. This method also allows us to calculate average unit costs, which are crucial for pricing decisions, ensuring compliance, and controlling expensive materials. So, process costing provides a structured way to manage and evaluate pharmaceutical production efficiently. Now, let's talk about some common challenges we face in process costing. One major issue is dealing with partially completed beginning inventory. This can make calculating equivalent units and unit costs more complicated because we have to factor in the work already done. Another challenge is managing transferred-in costs. These are costs that come from previous departments and need to be tracked separately from the current department's conversion costs to ensure accuracy. Then, there's the cost flow assumption. Choosing between weighted average and FIFO methods impacts how we assign units and costs, which in turn affects our cost calculations and financial reporting. Finally, we need to consider department variations. Each stage in production may have different completion rates, types of inputs, and patterns of loss, so the process costing approach must adapt to these differences for precise cost allocation. All of these points highlight the complexity involved in process costing and the importance of careful management. Now, let's talk about how spoilage is treated in cost accounting, specifically in process costing. First, we have to understand the two types of spoilage, normal and abnormal. Normal spoilage happens as a part of the production process and is expected under efficient operations. This type of spoilage is considered a cost of doing business, so its cost is spread across the good units produced or assigned to the output of the specific department. On the other hand, abnormal spoilage is unexpected and avoidable. Since it represents inefficiency or error, the cost associated with abnormal spoilage is charged directly to a loss account and excluded from inventory costs. Understanding the distinction between these two helps in accurate cost allocation and better management decisions. Here we focus on 3 key performance metrics that help us understand how efficiently a process converts input into output. First, the cost per equivalent unit represents the average cost assigned to each equivalent unit of production during the period. This metric helps us grasp the financial aspect of production efficiency. Next, the process efficiency percentage measures how effectively inputs are transformed into completed products with minimal waste, highlighting operational effectiveness. Lastly, the yield rate percentage shows the proportion of good units produced compared to the total units entering the process, giving us insight into the quality and success of the production process. Together, these 3 numbers provide a comprehensive picture of process performance. In process costing, effective cost control starts with closely monitoring materials, labor, and overhead for each department. This early tracking helps managers identify any shifts in costs before they become bigger issues. Next, analyzing these costs by comparing actual unit costs with standard costs, previous periods, and expected equivalent units provides valuable insights into efficiency and potential variances. Finally, the goal is to improve by reducing waste, streamlining processes, and addressing bottlenecks. By doing this, we can prevent higher costs from developing in the future, ensuring smoother and more cost-effective production overall. This continuous control through every production stage is key to managing costs effectively. Here, we're focusing on the role of ERP integration in process costing. ERP systems link materials, labor, and overhead data directly to each production process as it happens. This real-time connection means that cost information is immediately available, allowing managers to see cost trends much faster. With these insights, they can spot any variances early and make adjustments to operations before any losses become significant. This integration greatly enhances accuracy and responsiveness in managing production costs. Automation fundamentally transforms process costing by making it faster and more reliable, turning it into a system that supports quicker and better decision-making. One of the key benefits is access to real-time data, allowing managers to see production costs as activities happen, rather than waiting weeks for the information. This immediacy helps in responding promptly to any issues or changes. Accuracy is significantly improved through automated calculations, which reduce the risk of manual errors in tracking units, costs, and allocations. This leads to more dependable cost information. Efficiency is another major advantage. Routine costing tasks are completed much faster, freeing up staff to focus on more strategic activities like analysis and control instead of getting bogged down with repetitive data entry. Finally, reporting is streamlined through dashboards and standardized reports. These tools make it much easier to monitor cost trends and spot patterns, supporting better overall management of the costing process. Altogether, automation enhances every step of process costing, making it more effective and insightful. When working with process costing, it's really important to avoid some common calculation errors that can significantly distort our results. First, forgetting to include beginning work in process inventory can throw off our whole calculation because it leaves out costs and units that were already partially completed. Next, if we ignore partially completed units, we end up miscalculating equivalent units, which skews both the cost per unit and the final inventory values. Misclassifying costs is another big pitfall. Mixing up materials, conversion costs, or period costs results in inaccurate cost assignment and misrepresents departmental performance. Rounding too early in the process can create small discrepancies that might seem negligible but actually accumulate through the 5 steps, leading to bigger errors by the end. And finally, transferred-in costs need to be treated as a separate category. Lumping them in with conversion costs leads to cost distortions. Overall, getting the unit flow right and correctly categorizing costs are essential to ensure accuracy throughout the process costing system. These careful considerations help us avoid errors and produce reliable cost information. Here we have a practice problem designed to help us complete the 5-step process in process costing. First, we start with the summary of physical units. we see that the beginning work in process inventory is 2,000 units, 8,000 units were started during the period, 7,500 units were completed and transferred out, and 2,500 units remain in ending work in process. Next, we calculate equivalent units. Materials are 100% complete in ending work in process, while conversion costs are 40% complete. This distinction is important because materials and conversion costs are treated differently in the process costing system. Moving on, we summarize total costs. Materials cost $48,000 and conversion costs are $30,000, making a total of $78,000 to account for. These costs will be allocated according to the equivalent units calculated. Then, we compute the cost per equivalent unit by dividing the total costs by the equivalent units for both materials and conversion. This step enables us to understand the cost impact on each unit in terms of material and conversion costs. Finally, we assign costs to outputs, which means distributing these calculated costs between completed units and the ending work in process inventory. By following these steps, we ensure accurate cost tracking and inventory valuation in the production process. Let's review the key points about process costing. First, process costing is best suited for situations where identical units move continuously through production, like in manufacturing or chemical processing. Next, it's important to understand that the average unit cost is based on equivalent units, which take into account partially completed products, rather than just counting the units started or finished. The process costing method is structured around 5 steps: organizing units, assigning costs, calculating equivalent units, determining cost rates, and finally assigning costs to units. When it comes to methods, the weighted average approach blends costs from multiple periods, while FIFO gives a clearer picture of current period work by isolating it. Lastly, when products move between departments or have different features, transferred-in costs and hybrid costing systems become essential considerations. These points capture the essence of process costing and how it is applied in various production contexts. To build confidence with process costing, the key is to turn the framework into a habit you repeat regularly. Start by solving problems, then observe the results, and compare different methods to deepen your understanding. Practice is crucial. Work through calculation problems involving equivalent units, cost per equivalent unit, and cost assignment until these steps feel automatic and intuitive. Next, study real-world cases, especially in continuous production industries like chemicals, food, and pharmaceuticals. This helps you see why process costing is the best fit in these environments and how it's applied in practice. Finally, focus on mastering both the FIFO and weighted average methods. Understand when each method is most useful and how they differ, especially in how beginning inventory is treated, since this impacts reported unit costs significantly. Getting comfortable with these variations will really sharpen your skills. By following these next steps, you'll be well on your way to mastering process costing and confidently applying it in various scenarios.